have Fidelity Investments' John Gagliardi and Great Hill Capital Chairman Tom Hayes. Gentlemen, good to see you. Happy Friday.
Thanks for having us.
Happy Friday.
This is the backdrop. I'm going to begin with you, Tom, that we're in right now. Citi, they project 4 50 basis point hikes this year in May, again in June, again in July, again in September. Goldman Sachs, as many as 7 this year, as many as 5 next year. How come this isn't scaring the market more, Tom?
Yeah, well, our base case is that we're not headed for a recession, Lauren. I'll take the under on those estimates. However, we do not have to predict it. I can leave the crystal ball in the closet because the market will signal when we're going to have a recession based on the 2-year yield and the 10-year yield inversion, which we don't have yet. We're 18 basis points wide. If you look back to 1994, we got as narrow as 9 basis points wide before they stick saved it and expanded the cycle by another 5 years. I think we're going to see a similar situation, but it's up to the Fed. If they go aggressive on those 50 basis point hikes, they're going to invert the curve. We're going to have a recession. However, I think they're going to shift to the balance sheet roll-off quicker in May and go with more steady rate hikes. That would re-steepen the curve and potentially extend the cycle for another few years. In the meantime, the economy is hitting on all cylinders. Unemployment is still at 3.8%. You've got 11 million job openings. That's not a signal of a recession. Also, earnings estimates. Everyone's worried about earnings, Lauren. In the last 4 weeks, estimates for 2022 for the S&P 500 have gone up from 225 to 227.32 on the bottoms-up analysis.
Yeah,
and you have
Go figure, Tom, because you're talking about, you're a bull. I love it. But you're talking about these great signs on the economy, but companies face inflation too. And Bank of America today, John, they called inflation epic and said commodity prices are on track for their biggest increase in over a century, since 1915. Can we avoid recession in a Fed tightening cycle with inflation at these historic highs? John?
You know, I only like my parties to be epic. I don't like my inflation to be epic. But recession is part of the cycle. It's a normal, natural part of the cycle, like winter, spring, summer, and fall. I can tell you that Urian Timmer is our chief global strategist, and he believes that we're going to 3,800 on the S&P. That would be about another 10% down from where we are. A normal, natural sell-off, the average is about 18.8 for the last 50 years, and we're halfway there. However, long-term, I'm with Tom. Long-term, it's a whole different ballgame. The demographics still look great for the long-term. It's run by millennials. Millennials are going to be 75% of the workforce by 2026. They're now nesting. They're buying houses and cars. Everything that worked in the last run of the market is not working, but everything's shifting. Stuff that hasn't worked since 2007, materials, housing, real estate, even financials are all breaking out to new highs, and I don't see that changing.
My only pushback to that, John, would be that millennials haven't been through a rate hike cycle. I mean, they really haven't. So this is new to them, and also investing through it. Okay, so John, you were saying down to 3,800 potentially on the S&P 500, which is at 4,530 now. It can't seem to crack that 4,600 level. Why are we so range-bound right now, Tom?
Well, I think what you're seeing, Lauren, even if the yield curve were to invert today, the 2s and 10s, what you find historically is that's not a sell signal. It's actually a buy signal. Some of the steepest returns come in the 6 to 18 months after the inversion, before the recession. So, you know, speaking to what John was talking about with the millennials, he's spot on. One of the top companies that we like here is A.O. Smith. They make residential and commercial water heaters. You've got 72 millennials that are starting housing formation, family formation. This is trading at 25% off of its recent highs. And it's trading at a discounted multiple, 17.5 times versus its average of 20 times. So I'm with John with this theme of the millennial demand. That's normal that you're going to have an increased cost of capital when there's a demand for capital with 72 million of these millennials at age 31. So we remain optimistic. If the yield curve inverts, it doesn't mean run for the exits right away. You usually have a lead time, and there are continued gains for the following 6 to 18 months before the recession actually happens.
Send my best wishes to those millennials, because the house down the street from me was on the market for 10 days, and it got 31 offers. That's the market that they're competing in right now as rates push back up to 4.4%. John Gagliardi, Tom Hayes, I love that you guys agree, and I love the sentiment. Good to see you. Have a good weekend.
Thanks, Lauren. Appreciate it.
And Neo losing charge at this hour.